Hi, this is Roger Conrad. I'm editor of Canadian Edge. What I want to talk about today is something a little bit of a departure from the kind of issues that I have explored in the past, and that is taxation, and particularly taxation of dividends due to American investors. Obviously, we have a very, very big issue coming up here. In fact, two very big issues coming up here as 2011 approaches. One is the expiration of the preferential rate on dividends paid to U.S. investors. It's been 15% as the top rate since 2003. But the way these taxes were passed initially was that they would sunset after 2010. So Congress has to act and extend these rates. Will that happen? Well, we've just had a very momentous election in Massachusetts where a long-held Democratic seat went to a Republican, and also the Democrats' supermajority in Congress has now been broken. Does that mean that we'll see investor taxes extended? Well, the Obama administration has definitely been very supportive of this. The trade-off has been to increase the top rate to 20%, but to make the rates permanent. I think that's will be a bullish change because I don't think people have really priced in the impact of these tax cuts as they've always been viewed as temporary. So making it permanent, I think, will be bullish. And I think that 20%, while it will mean a higher tax rate for some, will, again, by making things permanent, by firming up what exactly the definition of qualified dividend is, I think will be very positive for income investments across the board. But again, Congress has to act, and if what we see over the next several months is just simply gridlock and we don't see budgets passed, then that could be very, very negative. There's an organization called defendmydividend.org, defendmydividend.org, and I encourage everyone to visit their site and sign on to their petition. Also, contact your congressman. This is an issue that is very important to dividend investors, and that's regardless of what you're invested in. Now, the second big issue, of course, is concerns the taxation of trusts. We're seeing more and more income trusts announce conversions to corporations and give us some clarification on what they intend to do with their distribution. Roughly half the converters so far, and whether they're completed conversions or conversions in progress, have elected to maintain their distributions at the same level. In other words, while many people had thought that dividends would be cut and dramatically when trusts converted to corporations, they proved the opposite. Of course, half the others have made cuts, but the market has treated those that have not cut or that have cut less than expected much, much better than it's treated companies that have cut. So I think managements are really stewing around with this, and I'm not a mind reader. I think some will probably elect to maintain the dividends. Some will elect to cut, but I do think most will beat expectations, and that's really the key to higher share prices. So even if you don't like the new dividend rate, you can still sell and at an improved price and then get into something that maybe yields a little bit more. So I think this is going to turn out to be a very bullish event for investors. There's one other thing, though, that we've been exploring in Canadian Edge, particularly in articles written by David Dittman in the Canadian Currents section, and you can look for more on this issue going forward. But that is the fact that under a amendment or an addendum to the U.S.-Canada tax treaty, IRAs are no longer supposed to be withheld for U.S. investors. In other words, Canadian trusts, Canadian investments paying dividends into IRAs have been being withheld at a 15% rate for U.S. investors. In other words, a U.S. investor do $1 worth of dividends would only get 85 cents under that regime. Well, under this new change, IRA accounts are not supposed to be withheld. So this is an issue that's caused quite a bit of confusion in the sector. We're looking up details. We're coming up with a very concrete plan of how to deal with this. Please check the Canadian Currents articles that will be appearing going forward. And again, there was one with the January issue. There'll be another with the February issue. We are going to tell you how you can use this to your advantage. In any case, a very, very positive development as IRA investors had not been able to file the Form 1116 on their U.S. taxes to get the 15% back. If you held the trust outside an IRA, you could file this and get back most or all of whatever withholding had occurred. But in the IRAs, you hadn't been able to do that. Now it's a moot point because IRAs are not supposed to be withheld the 15%. Again, a very, very bullish development for investors. I think another very, very strong point in investing in Canadian trust and converted corporations' favor. And it's something we'll be reporting more on going forward. So thanks for tuning in. Look forward to chatting with you next time.